Okay, good morning, everybody, and welcome to this KPMG webinar on executing successful due diligence in the current environment, given the challenges that have been posed by the COVID-19 pandemic. Although we are online, we've tried to create a virtual panel discussion where I'm joined by three fellow partners from KPMG Thailand, who all focus on M&A and due diligence, but have technical expertise across financial, tax, and legal. Let me introduce myself first of all. So I'm Ian Thornhill, and I'm the head of deal advisory for KPMG in Thailand, where we focus on giving integrated advice to both local and multinational clients on all aspects of M&A, market entry, fundraising, and restructuring. I'll just hand over to my colleagues to briefly introduce themselves. Tom, would you like to go first?
ครับ สวัสดีครับทุกท่านครับ Hi, good morning everyone. My name is Tom. I'm a partner in KPMG Deal Advisory Team. My main focus is on financial due diligence. It's a pleasure for me to be here.
Thank you. And Tatiana?
Good morning, everyone. My name is Tatiana Bespalova. I'm a tax partner focusing on M&A and international tax.
Hello everyone, my name is Bay Bunyaporn. I'm a legal partner at KPMG Law. My area of expertise is M&As and capital markets. Very happy to meet you here.
Thank you very much, and I'm looking forward to hearing you share some of your first-hand experience of navigating due diligence given the impact of COVID-19. But before we get into the discussion, I'll spend just a few minutes with a couple of slides giving an overview of recent M&A activity and trends and our views on the outlook for M&A as we go into 2022 and why it's going to be vitally important to execute due diligence and get deals done despite the pandemic. So first of all, looking at global trends, I think as many people are aware, M&A is booming around the world and deal values could hit more than $6 trillion by the end of this year. And for context, the previous record was 4.8 trillion in 2015. And even up to just September of this year, we're already at $4.3 trillion of deal value globally. So obviously, very active boom in M&A. And some of the key trends driving this are, firstly, technological transformation. Not surprisingly, technology and financial services sectors are the key drivers of deal activity at the moment. And that's driven by corporates looking to diversify and acquire technologies instead of develop them organically. But also significant funds raised by private equity funds and increased use of SPACs as well, all driving that deal momentum. Secondly, we have the recovery or the emergence of living with the pandemic. So I think even despite the evolving impact of Omicron, we're seeing a shift in both countries and businesses to try to live with the virus and be more open. And here in Thailand is a case in point, with borders opening up, the government trying to get the economy moving again. And certainly from what we're seeing, we expect positive M&A sentiment to be carried through into Q1 next year and beyond. The third point, and very importantly, is the availability of capital. And I think from a global economic perspective, this is very different from the 2008 crisis, which was primarily a liquidity crisis. At the current time, interest rates remain at historic lows. Central banks and governments have been supporting economies and pumping in stimulus. And this is all driving M&A appetite as businesses look for growth and to emerge from the trials of the last couple of years. A key question that remains to be seen is what impact this will have on inflationary pressures as we head into next year. And all these trends finally combine as CEOs are looking to ignite growth. M&A becomes a very attractive option to achieve this. And indeed, in KPMG's recent global CEO survey, M&A is clearly high on the agenda, with 87% of CEOs surveyed said they were looking to make deals in the next 3 years, and over half of them saying it was highly likely. So moving on to the next slide and looking at Thailand specifically, we do see a similar trend. And we know that public information on M&A deals and values is less reliable here, as not all deals are in the public domain, but even so, the trend is clear. The pandemic slowed things down significantly in Q2 of 2020. but appetite remained quite strong despite the challenges of lockdowns and closed borders, and M&A deals continued to happen. We know for our own activity levels in Q4 of this year, we continue to be very busy, and with borders opening up, we're seeing a lot of foreign corporates and funds now traveling here again and looking to make up for lost time. So we do expect 2022 to see more M&A activity, even though the pandemic is far from over. And that brings us to the topic of the panel discussion of how to execute due diligence and close deals in this environment. And just move on to the next slide. We see that finance, tax, and legal are just three of the areas that need to be addressed. And of course, there are many others, as represented by the wheel here, which are very important, but we don't have time to talk about in this session. But the way we approach it is to look at the various work streams an investor considers. And in almost every case, we see financial, tax, and legal due diligence at the core. And in Thailand, KPMG, we have an integrated team of specialists, including accounting, tax, and legal professionals, so we can provide that one-stop integrated due diligence solution for our clients. So as promised, that's the end of the slides for now, and let's get into the discussion, as this session is more focused on hearing from our financial, tax, and legal experts, talking about their experiences of executing due diligence over the past couple of years, and sharing key tips and recommendations of what we need to be aware of. And I'll split the discussion into three stages: a pre-due diligence phase, during the due diligence phase itself, and then finally post-due diligence, looking at how we take those diligence findings and ensuring a successful deal close. So first of all, as we look at the prior to due diligence phase, so COVID-19 has now been with us for 2 years and obviously had significant impacts on all aspects of our lives and work, and there's no sign that it's going away soon. So Tom, coming to you first of all, can you share your experience of how you've been approaching due diligences during the challenges of lockdowns, etc., and how has this changed how deals are done in the current environment?
Yeah, sure. Thanks for the question, Ian. Look, COVID-19 has been with us for 2 years now, as Ian mentioned, and obviously that has a significant impact on the way that we live in the world and the way that it impacts the kind of M&A work as well. So first and foremost, the real impact is the restriction on travel. And that kind of causes buyers and sellers to have difficulties in exchanging information without being able to travel, to visit the business, to have a face-to-face discussion, to visit the site. And that makes discussion to do deals becoming challenging. But I guess the kind of the positive note that comes out of COVID is that it actually accelerates the rate that we use, or the M&A professional that use technology, in a way that, for example, for discussion and communication, both buyers and sellers have now turned to use various softwares to do an online discussion, whether it's Microsoft Teams, WebEx, Zoom, or Skype, to ensure that there's an ongoing discussion takes place, ongoing negotiation that takes place. And also there's difficulty in exchanging confidential information as well. So those information are currently now being, as we've seen with a lot of clients that they've done, is that they are being uploaded onto the virtual data room, or VDR, rather than having previously as a physical data room. So information can be uploaded to the virtual data room quite spontaneously online, and the buyers on the other side can quickly download them, along with the buyer's advisor, due diligence advisor can quickly download them, and then every now and then can have a catch up with the sellers through using various tools and software. But the challenge still remains on, particularly for international investors, whether with the current travel restriction, how they're going to fly into the country and actually visit the sites, the warehouse, the machinery. How do they actually gonna inspect those? And I've seen various clients who come up with quite innovative ideas where they ask the seller to take the video of the premise of the site and then upload that video onto the data room as well, so that the buyer can see what the premise actually looks like. And then as a last resort, and becoming increasingly more, the buyers are now relying on third-party advisor, particularly the ones that are on the ground, to be their ears and eyes, who can actually visit the seller site and to perform, if required, any stock count, any check on assets, any check on fixed assets, etc. So the third-party advisors have becoming more and more ears and eyes for the buyers in this climate. But I think as the countries are now beginning to ease on the restriction, traveling hopefully should becoming less restricted, and hopefully we can get back to a normal level of doing deals.
Yeah, thanks, Tom. And I think, yeah, interesting to see how the next few weeks pan out with the impact of Omicron, and whether we'll see further restrictions, because that has been easing, obviously, in Thailand. Just another question around planning for DD. Obviously, whether COVID-19 is here or not, the quality and the completeness of the target company's data is a key driver of the efficiency of the due diligence process overall. And this is particularly important with when it comes to financial due diligence. The basis of preparation of the accounting information is normally the starting point for the DD phase. So again, Tom, sticking with you on the financial side, why is it important to understand the basis of preparation, and how has COVID impacted our approach from this perspective?
Yeah, sure. Thanks, Ian. Look, with or without COVID-19, I think that before you actually dive into the due diligence field work and doing the deep dive analysis, it's always important to understand as a primary objective, whether it's for the buyer or for the third-party advisor, to really understand how the accounts are prepared, the basis of preparation of those accounts. Management accounts of the seller's business, they quite often prepare on a monthly basis or on a quarterly basis, and these information are readily available, and they are usually the first batch of information that sellers normally provide to the buyers. So the buyer can take a quick look what the numbers are, and they can do the further analysis and preliminary valuation on it. But it's also important to understand the management account as the buyer receives before you deep dive into it, to really understand the assumptions that go in behind the accounts, particularly the accounting standards. What accounting standards are the seller using, whether it's the Thai financial reporting standard or the international financial reporting standard. So it has to be clear upfront how the management accounts are prepared, along with various assumptions that the seller's accountants may have built into, whether they close the month end or quarterly end on a properly basis. Do they do stock count? Do they adjust for standard cost and actual cost variance at each month end, or do they do that at each year end? So not only we need to understand the basics of account preparation, we also need to understand the limitation of it, so that you are aware of it when you come to analyzing it. And I guess once you have a good understanding of how the management accounts are prepared, the next step would be to try to reconcile that to the audited financial statement, which is the ones that are filed to the Thai Revenue Department, where the tax computation will get calculated on a net profit. So those reconciliations would normally be of two things. One is the audit reclassifications that the auditor may have adjusted, and the second one is the audit adjustment that came out from various audit procedures. So I think any incoming potential buyers or bidders would need to understand how those are linked between the management account and the audit account. And I guess once you get enough comfort around both management accounts and audit accounts, I think that's when you can really start to do a deep dive analysis, working on your preliminary initial valuation or forecast model. But you need to understand how they work first. So that would be my recommendation for this.
Okay, thanks, Tom. And I think, yeah, all of those things are more challenging for our clients and the target companies as well, when work from home, lockdowns, etc., have impacted how they do their month-end closing, etc. So I think now it's clear then, before we even kickstart the detailed due diligence, we're already having to approach the preparation and logistics of the diligence differently. So let's move on now to some of the specific due diligence issues that we see and need to be more aware of now as a result of the pandemic. And I think one of the one of the impacts that we've all personally experienced is that relating to workforce, working from the office, working from home, hours, etc. All that's been largely turned on its head by lockdowns, remote working, and other initiatives. Aside from the logistical challenges of adapting to this, there are also some potential tax and legal implications that our clients need to be aware of. So Tatiana, can you maybe just share some of the tax considerations about the new normal working environment?
Well, that's right, Ian. I think working remotely as well as travel restrictions present a number of challenges, and certainly in tax area. So what's currently happening is that a company might end up inadvertently creating a taxable presence or permanent establishment in a foreign country where it has employees, for example, based and working remotely in that country. So to give you an example, a Thai company, if it has executives or management based in that country, may trigger permanent establishment, but also might create a corporate tax residency. So a lot of jurisdictions assess corporate tax residency where the central management and control is located, rather than just based on the place of incorporation like Thailand does. Both permanent establishment and tax residency may lead to tax registration and tax filing requirements for a Thai company in those foreign countries, as well as potentially other statutory obligations. Payroll and personal income tax is another area that may be impacted if employees are working remotely in another jurisdiction. The issues here are around the personal tax residency of those employees, what withholding tax obligations may exist in those countries, how do you split the salary, what rates do you apply, but also whether you need to consider double tax agreements that may be in place. Some companies also started providing various benefits to their employees associated with working remotely. So we see, for example, laptops being provided or even home office furniture. And there will be a number of corporate direct, indirect issues, as well as personal payroll tax implications. So all of these issues now should be in focus of due diligence during these times.
Thanks, Tatiana. I think it's interesting. I think, there's always tax and regulatory issues that need to be considered as well. And I know a lot of companies are still making their decisions as to whether or not to embrace remote working more readily and reduce office costs and premises expenses. And that's be interesting to see how that pans out over the coming years. But another common impact that we've observed across several sectors in businesses that we've been looking at in terms of due diligence is businesses looking to reduce their labor costs whilst their business has been impacted by lower sales and poor performance due to the pandemic. And we've seen this being done in various ways, from termination of employee contracts, reduction of hours, reduction in pay, etc. So coming to you, Kumbunyapon, from an experienced legal perspective, what are the issues that investors should consider when looking at companies that have been implementing some of these measures to reduce employee numbers and reduce employee costs during the pandemic?
Okay. So on the termination, just want to go back on a work from home perspective. It's just in addition to Tatiana earlier, right? So from the legal perspective, there are two documents that the buyer should be looking at. The first one is the work rule, and the second one is the employment contract. So this document have to be looked at and see whether there are any restriction or prohibition for the company to implement the working remotely or the work from home process. If there are such restriction, then consent from the employee should be obtained. And if there is a change of the work rule, then there's a change of the working condition, right? It has to be registered with the Ministry of Labor. But if there is no such restriction, then there should be clear communication, documented communication to the employees. But then again, if the company is implementing the working remotely or the work from home, the working condition should still be the same. For instance, the workday, the working hours should still be the same. Those are the regulation and rules that the buyer should be looking at. In terms of the staff termination, these are the very important issues. First thing first that buyer should be asking is that prior to the due diligence, to 1 year, 2 years, or during the pandemic time, is there any termination of staff? If yes, then you have to look at whether proper notice of termination is delivered to those terminated staff. And normally it would be 1 month or just the period, the preceding period has to be observed. So if the proper documentation is delivered, the calculation of the payment is that correctly calculated. The severance pay is correctly calculated, so that this would be impacted to the pricing of the transaction, and whether the company would be obligated to pay the severance pay. How much would be the severance pay to make the payment to those terminated employees?
Yeah, okay. I think that's an couple of interesting points there, because a lot of businesses have been impacted and tried to act quickly and flexibly, and a lot of employees have also been willing to try and help in these regards. But it's important as well to check whether things have been done properly and appropriately with regards to the law. And from a due diligence perspective, the buyer needs to know if they're inheriting any potential obligations or liabilities if things were not done correctly, and there may be some employee liabilities and obligations that may come back to bite in future. So yeah, I think there's a few interesting topics there. But just moving on now, I think one of the most important topics that everyone, I think, will be keen to hear our experience about is understanding the impact of the COVID-19 pandemic on a business's performance, financial performance, revenue, profitability, etc. How we approach that from a due diligence perspective, and the impact, the potential impact on the deal and the findings have, and how to overcome those. So again, Tom, coming back to you from a financial perspective initially, what have you seen as the critical factors that have impacted business performance over the past 2 years, and how have you approached this, and how will you continue to approach this during a due diligence?
Yep, sure. Yeah, look, even before COVID-19 pandemic, performance of a business has always been one of the major areas that any potential buyers or bidders would look at. Now, with the COVID-19, it's even more now critical and important in understanding how the business is going through that pandemic and what the management strategies are in order to make that business survive during this period. So it's not a surprise why performance of a business would be looked at or scrutinized by the buyers, especially during COVID-19. But if I were to kind of break down the financial periods, especially historical financial periods that the buyer can look at, I mean, there are kind of two distinct financial periods historically. One is the pre-COVID historical periods, which is the most recent one will be 2019 and 2018. Where you can have a look at it. And then there'll be another group of financial periods where it will have COVID-19 factors being built in, which is 2020 and 2021, and probably 2022 and so on. But you'll see that there'll be two sets of financial periods, where one without COVID and the other one with COVID factor. Now, I think both sets of financial period can serve as a guide, but any investors or any potential bidders should not probably rely on historical information too much. We've seen a lot of KPMG clients where they're spending more time, and us including as well, looking at forward-looking information. And forward-looking information could be forecast for next year, for the next 3 years. It could be the budget, it could be confirmed order backlogs, it could be confirmed pipelines, could be executed, signed contracts. And I think those forward-looking information actually give more information regarding where the business is heading. where is it heading when it's starting to emerge out from the COVID-19 pandemic. So historical information, you can, to a certain extent, you can look at it as a guide, but more importantly, forward-looking information is even more critical. And general trend that we see, like Ian has mentioned before, is that majority of businesses would have had their revenue significantly adversely impacted by the COVID. Key customers are not placing an order, products are not being shipped out, inventory built up, large proportion of fixed costs remain high, and profitable business can quickly turn into a net loss position. And we've seen in certain industries, such as the hospitality sector, particularly hotel, transport, airline, tourism sector as a whole, where it's really been impacted by COVID-19. But then, we've seen certain industry as well that have really benefited from the pandemic, whether it's the medical sector, food delivery sector that's really got an advantage from COVID with people working from home, technology software companies where a lot of people are using more software licenses, exploring into more of a collaborative software where people can work remotely. And those have been really a kind of high-end sector where COVID is really applying the benefits to it. But the real key question that the investor will be asking to the seller and asking themselves as well would be, what are the real underlying performance of a business going through this COVID? And these are real hard questions to answer and require judgment and market knowledge, commercial assessment. But then they'll have to assess, what COVID factors are actually here to stay on a permanent basis, and what are here to stay only on a temporary basis. And it's a differentiation between those two factors that would actually allow you to perhaps form a prediction or a forecast more accurately. Let's just take maybe a top-line revenue first, for example. Top-line revenue, as mentioned before, we've seen few companies being adversely affected. But some companies have benefited from COVID. But what happened when COVID is over? I mean, will those benefits still remain? Are they actually sustainable? Will that revenue then decrease, or will they actually keep on going, projecting with growth? Some companies we observe, our clients observe that sellers' business has used strategy where a lot of discounts, coupons, vouchers have been applied, in order to enhance their revenue. But these promotional expenses actually can hurt your profitability, margins, and how sustainable are these strategies? And that's the judgment where I think the buyer, potential investor, and third-party advisor can come in and really have a real look at it. And furthermore, some companies have launched various new products during the pandemic. They've changed the business model slightly to suit the new consumer behavior during COVID. They may have formed a new business unit to target the underserved area during the pandemic. But are they permanent or are they temporary? And I think a couple of things that the buyers can do to address these. One is you can come up with a multiple forecast scenarios in order for you to assess the different potential outcomes of what the impacts of COVID to revenue could be. And the second is you can undertake a commercial due diligence. Commercial due diligence would give you a bigger picture on the market assessment, the product assessment, the consumer behavior assessment, and this actually can allow the investor a long-term view of how the seller's business would actually turn out to be in the future. So that was just a quick line on the top line revenue. On the expense side, actually, is where most investors, I would suspect, to kind of focus their attentions on. And there's a couple of things on the investor side that they should focus on the expense. One is, during the past 2 years of the pandemic, a lot of costs must have been cut. And all of these cost-cutting exercise, when the business is emerging out from the pandemic, will that cost come back? And if so, what are those costs? And these are what the investor will have to dig in. The third party will have to help the investors out. And those costs could be promotional costs, marketing costs, PR expense, when they would have been deferred to the next year or the future years, rather than conducting various marketing events in this current year with COVID. Will those costs come back in order to support the top line revenue? But other expenses that could be new, which have been driven by COVID, this could be, disinfection expense, cleaning expense, medical costs for the employee vaccination or COVID testing. And those are new normal expenses that could be judged of, are they going to be recurring going forward, or are they here to stay on a temporary basis? Same for the IT expense. A lot of companies are still having their employees working from home. They'll need to spend more on the IT infrastructure, IT servers, and software licenses. Are they here to stay, or are they here on a temporary basis? And I think once you started to get an understanding line by line of how the COVID actually impacts the profit and loss account, that's when you truly appreciate what the revenue will turn out to be and how the expense as well will turn out to be. And only then will you get a fuller picture of what the kind of bottom line EBITDA, normalized EBITDA would look like in order for you to to do a deep dive analysis and potential assessment for your further valuation.
Yes, thanks, Tom. I think a lot of very good points there, and yeah, a very well used phrase when it comes to due diligence valuation M&A is, the normalized earnings, and I think everyone can appreciate getting to what a normal earnings are in the current environment is much more difficult than before. But I think the key takeaways there is to really challenge and try and get the best view possible of what impacts on both revenue and cost are temporary, which ones are permanent, and help that build the vision for the future. So just briefly on sort of the impact of financial performance, impact of COVID. I'm sure there are some tax and legal implications as well, so we can maybe just touch briefly on those. Tatiana, maybe I'll come to you first.
Oh, thanks, Ian. And I think on the tax here, the sort of starting position really is to understand the target's response to the decline in profitability and consider tax implications of those actions. Have there been any changes to the business model, as Tom mentioned, supply chain arrangements, revenue recognition, receivables, debt management? All those potentially will have direct, indirect tax, but also potentially custom duty ramifications. So it's important for buyers to understand what they are, how the target managed tax costs and risks as a result of those responses, whether tax filings actually accurately reflect the position taken, and whether there is documentation exists to support that. If the target has accumulated losses, as a result of the decline in performance, buyers should really assess the quality of these losses. Again, are they just coming from the operations, or were there significant one-off transactions like debt write-offs, for example, that contributed to the creation of those losses? And what's also important for the buyers is to assess what value, if any at all, should be placed on those tax losses. And the typical considerations there is, are there any significant tax due diligence findings that may impact those losses, but also the period during which the losses can be utilized. So in Thailand, that period is 5 years. So it's very important to understand target's post-COVID recovery plan, when it will come back to the normal levels of profitability and when it expects to generate taxable profits, to really understand how much value it will bring to the buyers and under the new ownership. And they should be considered fairly early on in the deal negotiation, and potentially even pre-indicative bid, if the amount of loss is particularly substantial. And this is because the sellers often place value on the tax losses. They see that as being a very valuable tax attribute to the buyer, which it is, unless of course the buyers can't get access to those losses, or that they will expire before they can be utilized. So the buyers may actually want to place some significant discount on those losses.
Thank you. All very good points there. And Bay, anything else to add on the legal perspective?
Yes, from the legal perspective, the agreements that the target has with all of its counterparty needs to be checked and to understand the term of those agreements, whether there is any financial clauses that may impact the covenants or the revenue of the targets. And in terms of the change of the business model, the team who is doing the legal due diligence and the team who is doing the business model or the structure of the transaction needs to work together in order to form the best business model for the purchaser. For instance, just give the simple example. If the acquirer is a foreigner, right? Do they need another or additional business license or any kind of restructure that should be needed for the foreigner to come as a new investor? So the due diligence team would have to report to the structuring team as to what business license or how to best form the good business model in order to achieve this acquisition.
Okay, yeah, I think some very useful points there, and I think the impact of the pandemic on business performance is obviously a key focus of the diligence. I just want to say, if there are any questions that you have that come up for the participants, please put them in the chat box, and we'll have some time at the end to address those questions. So I think there's a few that have been coming in so far, but please keep them coming in, and we'll do our best to answer all of them. But let's move on now. So I think we've discussed financial performance and the importance of understanding the underlying or sustainable performance of a business on a revenue and profit basis. But let's remember that cash is king, as the saying goes, and that's especially so in times of distress. So as important as understanding the underlying profitability is, how do we look at how target companies manage their working capital and their cash flows in order to help them get through the impact of the pandemic, and what does that mean from a due diligence perspective? And I guess, Tom, this is probably more question on the financial side, aimed at yourself, please.
Yeah, sure, Ian. Yeah, I mean, working capital of a business, particularly the working capital profile under the COVID-19 pandemic, will have to be understood by any potential buyers, potential investors, in order to get an insight of how much cash is being locked in the working capital and the likelihood of those cash actually being released. And cash, as Ian mentioned, is king particularly in any business going through survival of the pandemic. And I guess if we were to kind of break down the components of working capital, there are kind of three key components actually within working capital, which are receivables, payables, and inventory. And if I can cover each one of them just quickly, for example, receivables, we see on various due diligence engagement over the past 2 years that our clients have looked at the target's business. Receivable balance have increased. Because the customer, their own customer, have struggled to make that payment back to the business. So the receivable have become increasing and also becoming more and more overdue. And I guess the concern for any potential investor would be to look at whether provisions have been fully applied or not, and also how likely are those receivables will be settled. And this will require lengthened discussion, negotiation with the seller's management in order to understand the profile of each of the debtor customer. I would actually recommend for any buyers to try and obtain the detailed receivable aging report and just go through line by line of each of the debtor and to see where the overdue balance is, and maybe put a question to the seller of, particularly those over 120 days, 180 days, to really get the answer from the seller of how will these be settled. And next balance is a payable balance, and I guess if the business is not receiving cash from the customer, it's very likely that the business will then ask their supplier to extend the credit term. So what you start to see is that the payables balance would also increase because there's no cash coming from the customer, and so there's no cash to pay out to the supplier. So they normally ask the credit term to extend, for example, from 30 days to 90 days to 120 days, for example. The key concern here for any incoming investor would be, will these long overdue payables be settled prior to closing or not? Because the risk is investor comes in, they're having to take the obligation of those long overdue payables, and then they'll have to settle that in the future once they become the owner of that business. And lastly, the last component of the working capital is the inventory. Majority of businesses would actually find it a struggle to survive under COVID pandemic, with products are not being sold, customer canceling orders, inventory gets built up in the warehouse, and key concern for the potential buyers here should be, are those still sellable, those inventories? Are they actually in a good condition, or have they expired? Has full provision been made on the inventory balance? Are they slow moving? Are they obsolete? And those are the kind of key questions that investor would normally ask on the inventory balance. And sometimes they get the third party advisor like KPMG to kind of attend the stock count and to assess the condition of those stock, which KPMG also can do for our client as well. But I think understanding each major component of that working capital can actually shed more light in terms of what are the kind of the normal working capital profile should have been had the COVID impact not occurred, had there been no long overdue receivable, had there been no long overdue payables, what would the working capital profile would have looked like? And I guess it raises the question of cash is now being locked in the working capital. Do you need external financing to come in and kind of finance the business while cash is currently being locked in working capital? And that would be kind of my quick summary on the working capital analysis.
Yeah, no, I think working capital is an area which we've long focused on as advisors, and we know it's a key driver of the cash flows of a business, and we know that there's a lot of cash that is being locked up in working capital under normal circumstances that could actually be released. But the COVID-19 pandemic and the impact of on the economy has really made a lot of companies focus on those working capital balances and the amount of cash that's in there and the amount of facilities that is required. So I think as we emerge from the pandemic, a lot more focus will be put on, in general, on managing things like debtors, payables, inventory, etc. But again, sticking with the kind of cash and financing theme, along with working capital, we also know that the capital structure and debt is a key driver of any company's balance sheet, and has been particularly stressed in some businesses as a result of the pandemic. And there are many target businesses that we look at which need to explore either refinancing or restructuring of their existing debt. And obviously this is important from a financial and valuation perspective, but there are obviously various legal and tax implications as well. So maybe Bae, I'll come to you first. I think you touched a little bit on this earlier, but from a legal perspective, what should a buyer be concerned with when assessing a target company that needs to potentially refinance or restructure its debt?
Yeah, so the first thing is that because of the pandemic, there may be potential breach of the loan agreement, right? They may not be able to repay the loan. So this type of potential default or default will need to be assessed whether there is a breach of any financing agreement. Is there any penalties or fines or any cost in relation to those breach? And importantly, is there any cross default provision? Because if there is any cross default provision, meaning that one loan is default, resulting all the loan is in default. So in that case, the total exposure would need to be calculated in order for the purchaser to know how much it would be the total exposure. So in case debt restructuring or refinancing is needed, the recommendation is that first thing, the target should be discussing with the lender as to how to deal with this, and then if possible, then getting the written waiver from those lender, or seeking new lender for doing the refinancing of these loans.
Yeah, I think there's lots of areas to consider when it comes to looking at an existing debt position, and especially potential refinancing. And Tatiana, I'm sure there are lots of tax considerations that need to be looked at closely as well.
Well, that's right, Ian. There are a lot of options, but what we see sometimes is that attempts to improve a company's cash flow position through debt restructuring can inadvertently trigger some tax liabilities that could, undermine the efficacy of these actions in the first place. So if not carefully managed, debt restructuring can have significant tax costs. So, for example, what I mean is that a release from an obligation to repay the debt generally is taxable to the borrower, and on the lender side, there is no relief by way of a tax deduction, generally speaking. So in the intra-group financing scenario, for example, debt forgiveness is actually a very tax inefficient option. Another issue that needs to be considered in the context of debt renegotiation or refinancing is interest withholding tax. So if there are any accrued but unpaid interests that are capitalized as part of the debt restructuring, they may be deemed interest withholding tax obligations, so triggering the actual tax cost, tax cash cost. The legal form of debt restructuring is also very important because it drives tax considerations. So normally we work closely with our legal colleagues, ensuring that the tax implications are taken into account before any legal documents are actually finalized. So, for example, a loan can be novated or a right to claim assigned, and depending on how it's done from a legal point of view, there could be different scenarios and different tax implications for the borrower, the old lender, and the new lender. And it gets even more complicated when those three parties are located in different jurisdictions, because then you have to consider also double tax agreements and what withholding tax rates should be applicable on the accrued interest as well as future interest payments. What I also wanted to note is that debt to equity swaps that are often available in some other jurisdictions in Thailand actually very difficult to undertake or not really available in the kind of more traditional form. So, the few considerations there, but what it all means in the context of the deal is that the sellers preparing for the sale process need to carefully consider any debt restructuring that was either undertaken in the past that may be diligenced by buyers or needs to be undertaken just before the sale, because the buyers would really would always put a lot of emphasis on the tax consequences during the due diligence process. And from the buyer's point of view, understanding all debt arrangements and any debt restructuring or modifications involving the target is also very important, as well as understanding, the full tax implications of any actions taken or proposed actions taken. And also the buyers really recommended to request all the documentation as part of the due diligence and make sure that, they have access to all of that information going forward, because in the event of a tax audit, that is normally would be one of the key focus areas for the tax authorities as well.
Yeah, so I think the conclusion there is that any kind of financial restructuring, debt restructuring, it's very important to consider not just the financial and the cash flow impacts, but the legal and especially the tax impacts, because they can be very complex and potentially quite costly if not done properly. I'd just like to add as well, just debt agreements and contracts and covenants breaches is one very important area, but it's important as well to look at all other contractual arrangements within businesses as well. So potential breaches in supply commitments or offtake agreements or various normal commercial contracts that have not been able to be fulfilled as a result of the pandemic. And all of these can have legal implications, but also financial penalties and potentially tax implications as well. And one area there, which is maybe not a contractual commitment, but it is an important commitment of a business, is around CapEx. So Tom, maybe coming back to you, we've seen a lot of businesses, obviously during the difficult times of the pandemic, try and reduce their cash outflows and deferring or not completing CapEx is one of the methods that we've seen. So maybe you can just share some examples of what you've seen in terms of this sort of deferral of CapEx in a due diligence perspective, and also how you identify potential CapEx shortfalls and what buyers can do about it to protect themselves from these risks.
Yeah, thanks, Ian. That's right. I think a lot of CapEx had been what we've seen in our previous 2 years of due diligence work during COVID pandemic. We've seen, target business have actually deferred their kind of large CapEx investment, but not only large. Some companies have actually deferred a normal maintenance CapEx that would have been done anyway, but they kind of deferred it to the future years in order to preserve cash. Now, the concern that investor would have would be the CapEx that they would need to catch up. And that means that, any portion of the CapEx that have been deferred, once the investor comes in, it will be investors' obligation, responsibility to kind of invest in those CapEx that have been deferred. Now, to minimize those risks, during the due diligence process, what the buyers and third-party advisors like KPMG can do is that we normally check whether the CapEx are being underspent or not, and we can compare that to the kind of average historical CapEx level. We can compare it to the budget that the management has set, and then any large differences where CapEx has not been invested in, ideally you should investigate further, and that can point to CapEx being underspent for those items. You should also try to understand if there are any major overhauls coming up, any major replacement of assets coming up, particularly if it's a manufacturing business. There'll be various machineries that have their scheduled maintenance, scheduled part replacement. And I guess you can look through the fixed asset register to look at the age of those assets and determine with your technical advisor to understand whether these assets have actually completed all of their operational useful lives or not, or will they need to be replaced in the coming years. And the way that we can actually treat any underspent CapEx is that we can try to put it as a purchase price deduction, where it becomes a debt-like item and just deduct off the headline purchase price. That way, the buyers coming in can have confidence that they're paying for the assets that are actually working in good working condition for the foreseeable future.
Okay. Yeah, I think that's something which we've seen across many businesses to trying to preserve cash. And I think on a similar note, just looking at moving on to related parties and related party arrangements, and we've discussed that many businesses have been hit with lower profits and tight cash flows, which may need additional debt and working capital funding. What we often see here in Thailand is a common source of soft funding, which we see in target companies that are part of a larger group of businesses, is receiving support from sister companies, whether it's a loan or extended credit terms, etc. As well as the normal interdependencies we see between group companies for shared services, infrastructure or IT, which obviously it's important, and we always focus on helping our clients to identify those kinds of entanglements from an operational perspective if the business needs to operate on a standalone basis. And but along with that, operationally, there's complex accounting, tax and legal implications as well. And again, related parties, Tatiana, is always an area which has a lot of tax implications. Maybe you can share some of the issues that you've seen over the past couple of years around related party transactions and the tax impact of that, of those arrangements as a result of the pandemic.
That's right, Ian. As you pointed out, understanding related party transactions and, their nature and pricing is incredibly important. And it was before COVID, but during the COVID pandemic, it's even more so. And this is because, naturally for a group of companies, it is commercially easier to alter its intergroup transactions as a way of quick response to the group's needs as a whole. And that's how some, what we've seen in due diligence is that's how some groups actually look at it. They look at it as a, way of sort of funding the underperforming sides of businesses or underperforming subsidiaries in particular countries by way of intergroup transactions. And it may make commercial sense and from the funding perspective, but from a tax perspective, sometimes it creates a lot of problems and a lot of risks. So, when faced with financial and operational difficulties, what some groups may be doing is looking at altering their supply chain arrangements between the related group entities. Also, more obvious things like intragroup charges for royalties, services, management support. They are either the pricing may changed, or it may be the payments may be paused or delayed, just to give relief to certain sides of businesses that need it. Another area is intercompany and shareholder loans. That's another obvious means to place cash within the group where, the part of the group where it's required most. And the issue there is that, sometimes those loans are provided on a short-term basis, but if they remain outstanding for a longish period of time, generally more than 12 months, that's where you can start running into some tax issues, because those loans really need to become interest-bearing and subject to transfer pricing. And that also actually applies to overdue intercompany payables. Another area that buyers really need to look at is whether target has any cross guarantees or cross collateral of assets within the target group, or also within the broader group of the seller potentially, and what's going to happen with those pre-sale. So in addition to your typical related party transactions and transfer pricing considerations that you would look at during the due diligence, which normally would focus on the nature of related party transactions, how they're priced, and whether transfer pricing documentation is in place. Now buyers also need to focus on, more broadly, what impact those intercompany transactions and the changes to those transactions may potentially have on the overall profitability of the group and its tax position. Does it contribute to tax losses in certain areas? And also whether transfer pricing documentation that the target may have in place, whether that remains appropriate. And just to comment specifically on that point of appropriateness of pre-COVID transfer pricing documentation. So transfer pricing analysis predominantly looks at people functions, assets deployed, and risks assumed by each company within the group. So it's important for buyers to actually understand what impact the COVID challenges and the target sort of response to those challenges may have had on those three factors. And whether the appropriateness of intercompany charges and transfer pricing documentation put in place pre-COVID is basically whether it's adequate.
Yeah, okay, so again, similar to debt restructuring, related party intercompany arrangements, transactions is always a very complex part of any deal, even pre-COVID. And because of the extra support and the complexity of businesses dealing with the pandemic, we're seeing that those kinds of entanglements can be even much more difficult to and complex to unwind, so that the buyer can get a nice clean company without any overly burdensome tax costs related to it. Just in the interest of time, so I do want to make sure we've got some time at the end to deal with some questions. Let's move on to the post due diligence phase now, and how we deal with those due diligence issues and factor them in to ensure the deal can actually go ahead successfully. I think we just discussed a lot of examples of common DD issues, which we're more regularly now seeing as a result of the impact of the pandemic. So how do we mitigate those issues, and how do we recommend that our clients to move forward and proceed with the transaction given the much more uncertain environment? Very broadly speaking, there's a couple of ways to deal with due diligence issues, if they're not a deal breaker, that is. One is around the valuation and purchase price, and the second is looking at legal protections via the SPA and transaction documents. So just want to have a few questions on this topic, and then we can get into the Q&A. I think the first question that many clients ask, obviously, is around the valuation. How does the due diligence findings impact the valuation? And maybe I'll share my own views on this topic first. And everybody knows that one thing that the pandemic has brought us is significant uncertainty. And uncertainty, by definition, means that it is very difficult to get comfortable with a valuation in the same way as pre-COVID times. So what we're seeing and will continue to see in deals, in order to bridge this uncertainty, is the use of more complex completion mechanisms, or things like earn-out mechanisms, whereby a portion of the purchase price is held back and only paid after 1, 2, or even 3 years post-deal, based on the target company hitting certain budgeted revenues or profits. So in theory, this makes both the seller and the buyer more confident that their downside is protected. And I think we're certainly seeing that already, and I think we'll see many more deals next year using these earnouts or other more sophisticated closing mechanisms more commonly. But aside from this, as Tom and Tatiana and Kumbunyaporn have mentioned, standard due diligence findings are more common around debt type obligations, working capital requirements as a result of COVID. And again, we need to ensure that those findings are reflected in the purchase price and potential purchase price adjustments, and in the SPA. But also, aside from the pure operational, financial, and valuation points, tax findings are always an important part of closing out any due diligence. So again, back to you, Tatiana. What have you seen from a tax perspective in terms of maybe the view from the tax authority in looking at audit trends and tax reliefs, and how are you advising your clients to deal with tax issues that have been identified during the due diligence?
Yeah, well, as we know, Ian, governments around the world, including Thailand, reacted with a number of stimulus packages to the pandemic to stimulate the economy, including different tax measures. So all of that obviously created fiscal pressures on the government and the tax administrations to collect additional revenue. What we also obviously observed is that during the lockdown periods, Revenue Department and other government agencies were also working from home, just as the private sector did for a period of time, and that slowed down a lot of tax audit activity. So now we've slowed down the economy overall with those fiscal pressures that I mentioned, with Revenue Department coming back to sort of working in the office. We actually started to see a lot more tax audits, and we expect that trend to continue. And what we also expect to see is a more aggressive tax audit. So what that means in the deal context is that identifying and quantifying historical tax exposures is actually more important than ever before, because the risk of those liabilities crystallizing is heightened. And we can expect that tax will be at the top of agenda during the deal negotiation. So when acting for buy side, what we recommend to our clients is to conduct a comprehensive full scope due diligence, potentially covering a longer period than they would otherwise pre-COVID pandemic. We also recommend seeking potentially price adjustments if there are some material and high risk exposures identified, and that goes to the point of valuation that you mentioned and all these different mechanisms. But also, we would be seeking we will be advising our clients to seek extended and enhanced tax warranties and indemnities in the sale and purchase agreement. On the seller side, being prepared prior to commencing the sale process is really the key. And this includes maybe conducting a comprehensive review of tax affairs, or maybe even doing vendor due diligence, ideally for at least the last 5 years, so that there are no surprises that the sellers are not aware, but the buyers can pick up on. And if any significant exposures are identified, considering whether they can be dealt with before commencing the sale process, through voluntary disclosures to the Revenue Authority. And having the historic positions, documented, and just being ready for, any queries from the buyers. That's really what will be important on the seller side.
Yeah, I think that's some really useful insights and examples shared there, because a due diligence is only as useful as the SPA or the final agreement that the parties come to. So I think it's really important that we as advisors ensure that all of the issues, whether positive or negative, have been factored into either the valuation, the business plan going forwards, or the SPA and other transaction documents to give our clients, certainly on the buy side, as much protection as possible, especially if we are expecting a maybe more aggressive enforcement regime going forwards. And obviously, one of the key areas which Tatiana mentioned of protection from tax risks and liabilities is the SPA, the sale and purchase agreement itself, and the other transaction documents. And so obviously, Kumbunyaporn as a legal M&A expert, maybe you can share some of the key challenges and practical issues that you've seen over the last couple of years, and how we can make sure that those due diligence findings are reflected in the transaction documents to protect our clients as much as possible.
Yes. So as Ian said earlier, the purpose of the due diligence, right? There are two purposes. The first one is to evaluate the transaction, evaluate whether to invest and how much, and the second one is to formulate the SPA. So after the due diligence has been conducted, all key findings of all work stream would have to come together, and then put those reflected in the SPA. Key items should be in the SPA, whether it is a condition precedent, it is a pre or post closing undertaking, or those known facts that are having the damages or having high risk should be listed as the specific indemnities, because some seller may say that they open the data room to you, you know everything, you have conducted all the due diligence, so everything you have conducted the due diligence, you cannot claim them, right? So basically the seller would be asking for this, but there are some items that contains very high risk and contain damages. Those should be listed as a specific indemnity. So even if you have conducted all the due diligence, you can still claim them as indemnity, specific indemnities. So these should be listed as specific indemnities. As to the practical challenges that we have seen earlier in the last deal I did with Ian, I think that was the deal that affect the closing of the transaction. So the SPA was good to go. We have drafted everything right. Normally at closing, right? Normally the closing would be happening within 1 day, right? You pay the purchase price, you deliver the shares, and you register with the MOC within 1 day. But for this deal, because it is a COVID and it was during the height of the infection, and everyone was infected with the COVID. So the MOC implemented the process that you have to pre-book the registration, and then when the one officer got infected, the matter was transferred to another officer, and then another officer also got infected. So this has delayed the closing process. We also have to amend that the SPA. So that is the practical issue that should be taken into account when drafting the SPA right now.
Yeah, exactly that. I think it's several weeks worth of delay to that, and I think that's a common challenge around business having to adapt to the new reality and being flexible to get things done during COVID, but sometimes regulatory systems, administrative systems, and bureaucracy aren't moving at the same pace. And again, it's just important to make sure that everything is done properly, even if it takes a bit more time. But I think just as we get close to wrapping up, and we'll deal with some Q&A soon. But I think a lot of the focus of the discussion today, as normal when we're talking about due diligence, is very much risk-based and looking at downsides. And that is, while that is a key, obviously a key consideration and a key objective of a due diligence, it's important to note that DD is not just about finding risks, not just about finding the bad news. It's just as important to look for positives and upside as well, including ways to increase value post-deal. And one of the things which we try and do as advisors is not just do a standard financial, tax, and legal due diligence. We like to understand the real deal drivers behind why our client is looking to invest in that particular company, and help to validate and enhance that those hypotheses around the additional value that investment will bring. From a financial and operational perspective, we do this with the due diligence data by applying advanced data analytics benchmarking to identify potential areas of upside around revenue, EBITDA, and cash flow. But also from a tax perspective, there's ways to unlock additional value potentially based on whilst doing an acquisition, based on some of the findings that we come across in the due diligence as well. So maybe Tatiana can share some examples and some views on this point.
Yeah, sure, Ian. And as you pointed out, it's not all about negatives when we do due diligence, right? There is always, and from tax point of view, actually, there are challenges, but there are always opportunities. So pretty much every area that I spoke about, in the last hour, also has potential opportunities. So when we are doing due diligence and work with our clients, we not just focusing on the historic tax exposures, but we also think about how effective tax rate of the group and cash tax position can be optimized post completion. So a few areas that I mentioned earlier, like business models, for example, or deductibility or restructuring of the debt obligations. Those areas is something that also can be looked at to actually improve the minimize the tax cost and improve the post-tax cash. We also often work with clients and in considering internal post-acquisition restructurings through business combination or amalgamation that may speed up loss utilizations, for example, particularly combining profitable and loss businesses, whether that's acquired target or the existing business on whichever side it may be. Deductibility of bad debts and bad debt write-offs is another area. It's there are various conditions that need to be met before written off bad debts can be deductible. So for business that may have a large volume of that, or that it's specifically relevant, there are certain ways and certain actions that can be taken to maximize the deductibility. So another opportunity that I quickly wanted to mention is transfer pricing. Whilst this is a sort of high risk area that we often focus as part of due diligence, as I discussed earlier, it's also the area that may be revisited post acquisition to enhance the overall post-tax position of the group, and see if transfer pricing fully maximized to utilize deductions in the more profitable sides of businesses. Another point on the transfer pricing is that by using the most recent financial statements, because that's what transfer pricing benchmarking analysis is based on, it's based on financial data. So by using the most recent financials and updating the benchmarking studies, by using comparables, by using financials comparables, during the COVID time that have been impacted, you might actually end up with a better outcomes of the transfer pricing review. So these are kind of key areas where we'd look at some potential value adds And what we have in M&A tax group is post-deal M&A tax advisory team that focuses on actually picking up some of these areas during the due diligence and then working with our clients post-completion or leading up to completion and post-completion to optimize the acquisition and achieve some tax benefits.
Yeah, thanks. And I think it's key is I think one of the key takeaways that I would like everybody to leave today with is don't see due diligence just as a risk identification and risk mitigation exercise. During a due diligence, you get so much access to information about a target company. There's so many more ways you can use that data more effectively to look at how you can enhance value, improve revenues, reduce costs, synergies post-transaction, and also importantly, improve cash flow, whether that's from the tax aspects that Tatiana mentioned, or as we discussed earlier, looking at working capital optimization and other types of restructuring as well. We're coming up to time, so I'd just like to maybe wrap up here and start looking at some of the questions that we can address. And I think maybe Tom, I'll come to you with the first question. You haven't spoken for a while. We have a question about whether there was an impact on KPMG doing a due diligence, whether it would affect our independence if KPMG is also the external auditor. Tom, can you take that one?
Yeah, sure, Ian. Yeah, I mean, look, the conflict would normally arise if KPMG is an external auditor and then another KPMG team is working for that client that has an impact on the financial statement, and then the auditor would then review and audit that financial statement, which then causes a self-review conflict. Now, our due diligence process, we perform a due diligence on the target or the seller business. And our normal findings are factual based, i.e. we report what we found. So there's no assurance being expressed, there's no opinion that will be expressed from KPMG due diligence team whether the buyer or the client will need to invest this is a good opportunity to invest. There'll be no such assurance or opinion being expressed. The decision making will still be up to the client whether to go ahead and invest or not. It will be up to the approval of the board, not the approval of KPMG due diligence. So, yeah, and we'll have a two separate in a normal working profile. We have two separate independent teams, one for audit and one for due diligence team. So there should be no conflict.
Yeah, thanks, Tom. Yeah, I think just the conclusion is, if KPMG is the auditor either of the client or of the target, actually, we manage those. We regularly work on those types of projects, and the any potential conflict of interest and independence threat is normally managed by our internal systems. We have separate teams and processes, and should broadly speaking, generally speaking, would not prevent us doing that work. Just looking at another question coming in, which is that I think both Tatiana and Bay touched a little bit on structuring or acquisition structuring earlier. So the question we have is when potential showstoppers or deal breakers are identified as part of the due diligence findings, what are the types of acquisition structuring solutions that we could that we've seen and we could help to implement? Maybe Tatiana, I think often based on your conclusion on some of the tax risks as well, one of the ways that they are mitigated is by looking at doing asset deals. Maybe you can share some examples and some views on how acquisition structuring can help.
Yeah, and it's actually a good question, and share acquisition obviously very often an easiest way to do the deal, from a sort of commercial perspective. But with share acquisition, the historic tax liabilities stay with the target company, and therefore the new shareholders, the buyer, would assume all historic liabilities. So, in the context of a deal where, as part of tax due diligence, we identify significant historic liabilities that cannot be resolved through the, purchase price adjustments, for example, because they're very significant and the parties just cannot agree on the quantum and the value, or cannot be addressed necessarily adequately addressed through the transaction documents and share purchase agreement. Because indemnity and warranties, for example, might not necessarily have a significant value and may not be claimable depending on the profile of the seller. So we see a lot of those situations. So sometimes there is no choice, but in order to do a deal, the buyer needs to acquire the assets of the target and put in a clean company so that those historic liabilities don't come. There is another aspect there that needs to be sort of evaluated, is any tax attributes will stay with the target company. So if there are losses, for example, those can't be transferred, so they won't be lost. So there are a few things there that would need to be balanced. And again, we see asset deals not necessarily being obviously the preferred transaction structure, just because it's generally harder to execute. But if there are significant tax liabilities, sometimes that's the only option.
Yeah, and I think it's an area where we see it's normally either significant tax exposures or legal exposures, which lead to an asset deal being the only real preferred method. But then, there are lots of complexities, not least ensuring that all of the assets are transferred and owned by the buyer post deal, and that includes things like employees, all of the IP, contracts, licenses, etc. So yeah, it can be difficult to implement, but sometimes it is the only solution. Another question came in, which is what additional considerations should be given if the target company is a listed company on the SET? Bae, do you want to take this one?
Yes. So the main key important issues, if the target is the listed company, is the first one is the confidentiality. Second one is the leakage of the information. The third one is the insider trading. So because when the purchaser is doing the due diligence on the target company, who is a listed company, the confidentiality has to be protected very strictly. And because if the information is leaked to the market and the stock exchange asks the target if there is any potential acquisition, the target has no choice but to say about the truth. So this has to be communicated with all the work stream on the confidentiality. And also normally in case of we are doing the due diligence or doing the acquisition deal, if the transaction is still not public yet, there should be memo to all of the working people that this is the sensitive information and restricted from buying the shares of the target or the purchaser. So that would be the key consideration in doing the due diligence in the target who is the listed company.
Yeah, thank you, Bae. I think we have time for just one more question and then have to wrap it up. The question is, so apart from obviously the focus here is on financial tax and legal, but apart from financial tax and legal, what other types of due diligence should be undertaken? Maybe Tom, I can come to you. I think you shared a couple of examples earlier around commercial due diligence, etc. What other typical due diligence do we see as part of a normal deal process?
So obviously the three main one being financial, tax, and legal. And quite often we see other aspects of due diligence being conducted as well. For example, you can have commercial due diligence where you study the market assessment, competitor, consumer behavior. You can also have IT due diligence, where the IT due diligence team would go in and study the target's business on various IT infrastructures, the various modules, IT system, accounting software, payroll software, ERP system that the target uses in order for the buyer to plan for the IT integration post-deal. You can also have HR due diligence, where you kind of focus on the employment the contractual obligation with their staff, the pay, benchmarking with the market rate, and various important clauses within those contracts. For example, termination clause, notice, and also, other aspect that buyer would want to look into is the contract with the senior management role, where the buyers may look to either keep or terminate, and those kind of HR due diligence will kind of shed some light into it. But also over the recent years, we see an increase in other aspects as well, whether it's technical due diligence or ESG due diligence, environmental due diligence, where it's becoming more and more prominent now, and we see our clients conducting those as well.
Yeah, thanks. And I think there's there are many different types of due diligence across all aspects. So I think I'll just come back to the key point I made earlier, which is don't look at due diligence just as a risk-based approach. Actually, it's most effective when we can embed ourselves into the client's overall deal strategy team, to not just look at negatives and downsides, and also help to validate the investment hypothesis, investment thesis, and help to identify and deliver a successful deal post-closing as well. We've got the time now. I think there's a couple of additional questions that we didn't get the chance to address, but we can certainly reply to those offline. Do please scan the QR code and give feedback on the session and suggestions for any additional topics going forwards. And we'll be sharing the slides and a link in an email post this session, which will also have a link to a document which we've just launched, dealing with many of the topics that we've talked today around differentiated due diligence during the COVID-19 pandemic. That's on the screen now. So thank you very much for your time. Thank you to Tatiana and Kumpunyaporn and Tom. We hope you found it useful. Please do get in touch with any additional questions, or if we'd like to discuss any of these topics in any more detail. But we'll call it a day now. Thank you, and have a good day, and hope to be meeting you in the new normal very soon. Goodbye.